Yesterday after a half-day trading session on Black Friday. But could this upward trend continue into next year? Joining me now is Gene Marks, certified public accountant, CPA, and business columnist for both Washington Post and Forbes. First of all, what do you think of Bezos, huh?
You got to love that guy, don't you think, Arthel? I mean, does anybody have a problem with Jeff Bezos making that kind of money? I mean, Amazon is awesome, right?
The only problem I have is that I cannot refer to him as Uncle Jeff. I wish I were related. You know what I mean? All right, tell us what's behind this good news.
Listen, I mean, the news has been obvious for anybody that's been keeping up with the news, Arthel, right? I mean, the economy is going well. I mean, remember, when you're investing in stocks, you're investing in the future. So the market itself is building in any gains that it thinks it's going to have in the months to come. And right now, things have been good. I mean, the economy is at a 3% clip, which is certainly an increase. The business environment is certainly more friendly with the Trump administration. A lot of my clients are real happy about that. You know, confidence is up from consumers. Business confidence is up. Investor confidence is up. Interest rates are relatively low. Inflation is relatively low. Unemployment is relatively low. The numbers are good. And I'm happy to hear that when I speak to so many people that sometimes can't make sense out of the stock market. This market kind of makes sense when you consider where the economy is right now.
And listen, I certainly don't want to be Debbie Downer, but when things are good, a crash or perhaps a correction usually is in the near future. Is that the case?
Yeah, I mean, first of all, Arthel, listen, I'm a certified public accountant, so it's my job to be a Debbie Downer. So whenever I look at things that are going on, I'm always trying to look at, you know, well, what are the risks here, and, you know, what should we be advising our clients? And yeah, there are risks that are out there. I mean, I don't foresee, and most analysts don't foresee some type of a big crash happening in 2018, but it's not out of the realm to expect some type of a correction, a 10 to 20% correction. I mean, there's a lot of factors that are out of our control in the American economy. Look at China, for example. China just put $133 billion into their economy just last week to try and shore up liquidity. They have huge debt issues. China's the world's second biggest economy. And do you remember back in early January in 2016, the Chinese market dropped like 18% over a few weeks, and the American market dropped about 8%. And in today's numbers, that could be like a 2,000-point drop. So China's a perfect example of something that, you know, could go wrong that could have an impact on rates. And then, of course, there's other international things. I mean, a war with North Korea would have a big issue, you know, for us. A spike in oil prices that's not foreseen could have a problem. Even tax reform. I mean, right now, a lot of my clients, a lot of investors, they're building in, more profitability in 2018 because they're seeing hopefully a reduction in tax rates with the congressional tax reform. If that doesn't happen in the Senate over the next few weeks, then I think that could have a big impact on markets. So, you know, all of those factors in general, you know, and a few of them we're not talking about, anything like that could have an impact to our market. So I just don't expect to see a giant drop, but a correction is not out of the realm.
Well, that's good. That's good. I mean, you know, corrections, I guess, do happen, and they are for a good reason.
They are.
You know.
I can tell you this much. I can just tell you this much. When I talk to clients, you know, look, I mean, unless you're an individual stock market or picker, and, you know, you're working on the markets, and, I mean, I don't know you that well, but I'm assuming you're not, and neither am I. As for the typical investor, you know, you want to have a professional that you're investing with. You want to have money in a good mutual fund, a good financial planner that can advise you. You keep yourself diversified. And, you know, we like to tell our clients as well, listen, markets go up and down, and really over the history of time, the stock market is really one of the best investments you can make as long as you're in it for the long term. So don't get spooked if there's a correction next year. Stick with it, and as long as you're diversified and have good advice, it's always a good investment to make.
Hey, Gene, though, what if folks have a little extra cash to invest or maybe just save before the end of the year? What do you think they should do with it?
Well, I mean, first of all, you can always invest in my company, Arthel. I'm just kidding. No, don't do that. What you can do is you should be putting money away, diversifying your assets. If you've got a lot of money that are in the markets right now, maybe you want to put it somewhere else. I mean, savings rates are very low, but you can diversify yourself. So if you talk to your financial planner, putting money into different funds, whether it's a bond fund, a stock fund, an S&P 500 fund, even a real estate fund, a good financial planner or a good investment manager can give you some advice where where you should put it. So there's not one answer for everybody.
Sure.
You want to talk to somebody that can look at your overall assets and make sure that you're diversifying yourself well.
Yeah.
And as long as you're diversified, you should be in good shape.
Okay, Gene Marks, thank you very much.
Thanks, Arthel. Great talking.
Same here.